Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pegasystems Inc. Annual Report. Pegasystems Inc. offers a wide range of software solutions and services to various industries. The company's portfolio includes Pega Infinity, which comprises three key components: Pega Customer Decision Hub, Pega Customer Service, and Pega Platform. These tools enable businesses to make data-driven decisions, automate customer interactions, and streamline operational workflows. In addition to these core offerings, the company provides several specialized services and products. Situational Layer Cake is a unique feature that organizes logic into layers tailored to each client's business needs. Pega Gen AI Blueprint allows for rapid prototyping and accelerated application development. Pega Cloud enables clients to develop, test, and deploy applications efficiently. The company also offers training and enablement services through its Pega Academy program, which provides instructor-led and online training to employees, clients, and partners. Furthermore, Pegasystems Inc. provides global service assurance and client support services to ensure the smooth operation of its software solutions. In terms of marketing, the company targets various industries, including financial services, healthcare, communications and media, government, insurance, manufacturing, high-tech, and consumer services. It utilizes a direct sales force, as well as partnerships with technology providers and application developers to reach its target markets. Unfortunately, I do not have access to the extracted summary. However, I can provide a general essay on what may cause a stock price to drop. The decline of Pegasystems Inc.'s stock price over the past year is likely due to a combination of factors. One possible reason is the company's failure to meet investor expectations in terms of revenue growth and profitability. This could be attributed to various internal or external challenges, such as changes in market demand, increased competition, or difficulties in executing business strategies. Another potential cause for the decline is the impact of macroeconomic trends on the technology sector. Economic downturns, trade wars, or shifts in consumer behavior can all negatively affect companies like Pegasystems Inc. that rely heavily on software sales and customer relationships. Additionally, changes in industry trends or the emergence of new technologies could also contribute to a decrease in stock price. Furthermore, poor management decisions or governance issues may have led to decreased investor confidence in the company's ability to deliver long-term value. This could include factors such as executive turnover, accounting scandals, or other forms of corporate malfeasance that erode trust among investors and analysts. Lastly, external market forces, such as changes in interest rates, currency fluctuations, or shifts in global economic power dynamics, can also impact a company's stock price. These factors are often beyond the control of individual companies, but can have significant effects on their financial performance and investor sentiment. In conclusion, the decline of Pegasystems Inc.'s stock price over the past year is likely due to a complex interplay of internal and external factors. Understanding these causes requires a nuanced analysis of the company's business operations, industry trends, and macroeconomic conditions. Pegasystems Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Pegasystems Inc. trades at a higher price-to-earnings ratio of 25 times, and a higher price-to-book ratio of 11 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, Pega Cloud has been a significant contributor to revenue expansion. Additionally, subscription services have played a crucial role in driving revenue upwards, as have subscription license revenues. Consulting revenue has also been a key driver of growth, with contract modifications and amendments to existing contracts further boosting revenue. On the other hand, certain factors have led to revenue decline. Maintenance revenue has decreased, while consulting revenue has declined as well. Software license sales have also seen a downturn. Furthermore, the reclassification of perpetual licenses into subscription licenses in 2025 has impacted revenue negatively. Other factors that affect revenue include changes in the fair value of investments and gains from the sale of investee companies. Deferred commissions and amortization, as well as operating lease liabilities and prepaid expenses, have also had an impact on revenue. Net income experienced a decline of 9% in 2024 and 8% in 2023, indicating a downward trend. However, this trend reversed significantly from 2023 to 2025, with an increase of 297.25%, and from 2024 to 2025, with an increase of 296.83%. This substantial growth suggests that the company's financial performance improved dramatically over these two-year periods. Profit margins also underwent a significant transformation. Initially, there is no direct statement indicating a decrease in profit margins. However, it can be inferred as such from page 53. Nevertheless, the data on page 42 and 54 reveals a substantial increase in profit margins. Specifically, they rose from 15% in 2024 to 58.9% in 2025, representing an improvement of 43.9 percentage points. Additionally, calculated values show that profit margins increased from 6.6% in 2024 to 22.4% in 2025, a rise of 15.8 percentage points. These significant increases suggest that the company's profitability improved substantially over these two-year periods. The company is generating a significant amount of positive operating cash flow. According to the financial reports, in 2024, the company generated an operating cash flow of $345,926, which increased by $159,301,000 to reach $505,227 in 2025. This substantial increase indicates a strong improvement in the company's ability to generate cash from its operations. The data also shows that the company has been consistently generating positive operating cash flow over the past few years, with an increase of $187,442 in 2023 compared to 2022, not mentioned. The consistent growth and significant increase in operating cash flow suggest that the company is on a solid financial footing. The company's debt level and interest expenses have undergone significant changes in recent years. A review of the extracted summaries reveals that total liabilities have decreased substantially, from $1,182,793 to $844,463. This reduction is largely attributed to the elimination of convertible senior notes, which decreased from $467,470 to $0. The company's long-term operating lease liabilities also saw a decrease, from $67,647 to $60,825. Furthermore, there were no borrowings under the credit facility as of December 31, 2025. These changes indicate a reduction in the company's debt obligations. In terms of interest expenses, the company has experienced a significant decline. Interest expense decreased by 81% from 2024 to 2025, while net interest expenses saw a decrease of 40%. Additionally, interest income decreased by 47% over the same period. These changes collectively suggest that the company's debt level and interest expenses have undergone substantial reductions in recent years. Management is emphasizing digital transformation through AI-powered decisioning and workflow automation to drive business outcomes. This involves delivering consistent customer experiences across channels and internal data silos, accelerating collaboration, development, and time to value through Blueprint. The company will focus on delivering solutions tailored by industry to help enterprise-scale businesses and government agencies achieve differentiation in the competitive markets they serve. To support this strategy, management is investing in growth, which may result in decreased profitability or losses in the short term. However, they expect increased demand for cloud and maintenance support, as well as a strong market capacity for implementation services through partner-led and client-led implementations. The company's consulting revenue is dependent on its personnel implementing new license and Pega Cloud arrangements. Management has committed to a restructuring plan within the consulting organization to align roles and capacity with an AI-first delivery model, resulting in a $13 million restructuring expense. Despite increased competition for market share and pressure to reduce prices, management believes it has strong grounds to prevail in trade secret litigation and has sufficient liquidity to fund operations, stock repurchases, and quarterly dividends for at least 12 months. The company's financial activities involved both acquisitions and divestitures during the specified period. In terms of acquisitions, the company recorded a significant goodwill amount of $81.5 million. Additionally, one of its investees was acquired by a private entity for $33.2 million, resulting in a gain of $18.7 million. On the other hand, the company engaged in divestitures, which included the sale of investments worth $35,164. These transactions demonstrate the company's strategic efforts to manage its assets and investments effectively. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been consistently reported in various sections of the document. This indicates that the company has prioritized distributing a portion of its profits to its investors. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share for existing shareholders. The fact that this activity is mentioned alongside dividend payments suggests a deliberate effort by the company to maximize shareholder value through both direct distributions and strategic capital allocation. That concludes the financial summary for Pegasystems Inc. Feel free to comment below, and I will be happy to answer them when possible.